All right. Welcome to another earnings reviews video. We're done with week number one of the most important earnings seasons in stock market history. Why? Because these earnings not only tell us how these stocks are performing so far at this stage of the cycle when we have anticipation of an upcoming recession, but these earnings also serve as a pulse of what's going on with the economy. They present us with the early warning signs of what's about to happen in the economy, and therefore analyzing these earnings is extremely important, not just because of buy and sell decisions of individual stocks, but also because of what they tell us about what's happening in the economy. What's about to happen? Last week, we got a lot of them. We're going to cover some of them, the most important ones. I'm going to cover Goldman Sachs, Lockheed Martin, Netflix, CSX, Tesla, American Airlines, Snapchat, and American Express. Let's start by Goldman Sachs. The headline reads, traders at Goldman Sachs were able to capitalize on volatile markets last quarter, cushioning a profit drop. Still, Goldman Sachs executives said the bank would be cautious for the rest of the year. Now, this is a stock that I used to own. It was one of my top performers last year. Amidst the stock market mania, of course, Goldman Sachs tends to benefit, but do they also benefit when the stock market crashes, when we see volatility, and can that benefit offset the losses from a stock market that is not going higher? Well, let's see. An important pulse for the health of the global economy, which regions are doing better than others, is when we look at the geographic net revenues and net profits for each company. For Goldman Sachs, when we look at the net revenues, for the Americas, revenue was down by 30.5% year over year. Not a good look here. But we also have the EMEA, Europe, Middle East, and Africa. That was down 11.5% year over year. And lastly, Asia, a stunning drop of 24.4%. So we see weakness across all regions. This is not just limited to the United States or Europe. This is a worldwide story. Global markets are down across the board, so it is not a surprise here. Yet when we look at the different segments for Goldman Sachs, when we look at the revenues, investment banking, the revenues went down by a stunning 48% year over year. And this is, of course, because the stock market is down. Then investment management, that was up by 26% year over year. What happens when your investment banking revenue is down? You charge more in commissions and fees. And therefore, Goldman Sachs commission and fees revenue was up by 29% year over year. And most importantly, market making, this is the manipulation revenue, that was up by 51% year over year. All in all, the revenue for Goldman Sachs entirely was down 26% year over year. So this is not good. What about the expenses? Are the expenses going down or are they going up? What's going on here? Well, all in all, the operating expenses for the company went down by 11% year over year. So this is good news, but bear in mind that the revenues went down by 26% year over year. And when we look at certain segments and expenses, it really raises eyebrows. For example, while compensation and benefits expenses went down by 30% year over year, they're probably paying Goldman Sachs bankers less. I hear from these people all the time, they're not happy, period. But the good news is professional fees are up 42% year over year. Likewise, market development expenses went higher by 104% year over year. But the most important expense is compensation and benefit. That was down 30%. Therefore, all in all, expenses are down 11% year over year. The bottom line, net earnings was down 47% year over year. This is a stunning number. The story in Goldman Sachs being a hot stock, that's over now. And it has been over for a long time. Next, we have Lockheed Martin. What's going on here? The headline reads, Lockheed Martin cuts its full-year sales and profit guidance as continuing delays are challenging the industry's return to growth. Well, let's take a look at the numbers. Each segment of the company, looking at the net sales for aeronautics, there was a slight bump year over year. It is negligible in the grand scheme of things. When we talk about missiles and fire control, net sales were down 11% year over year. For the rotary and mission systems segment, revenues were down by 14% year over year. And for the space segment, revenues down by 15% year over year. All in all, net sales for Lockheed down by 8% year over year. When we look at the operating profits, are they beating inflation, not beating inflation? Clearly not. When we look at the operating profit for aeronautics year over year, that's down 2%. For missiles and fire control, that's down 3%. For the rotary and mission systems, that's down 20%. But for space, the operating profits went higher by 8% year over year. All in all, the operating profit for Lockheed Martin went down by 5% year over year. But perhaps more important than the operating profit is operating margins. For aeronautics, the operating margin was was negative year over year. For missiles and fire control, it was actually higher. For rotary and mission systems, the operating margin was down year over year. Yet for the space segment, the operating margins improved dramatically. So the hottest segment that we have in Lockheed is space when we talk about growth. On the other hand, the rotary and mission systems was the toughest segment this quarter. Now, these numbers are not good, because all in all, the net earnings went down by 5.66% year over year. Not a good quarter for Lockheed. But why am I keeping the stock in my portfolio? Why did I add to it? The answer is what's in the pipelines. All of these stocks that you're hearing from, Walmart, for example, after hours, all of these tech companies that are about to report, you're going to see that all of these companies cannot withstand the pressure of a recession. Their top and bottom lines will go down. But there is not going to be a recession in Lockheed Martin. Who's the biggest customer of the company? The answer is the United States government. With unlimited cash, with a proxy war going on, the funding for Lockheed will be hot, hot, hot. Number one, replenishing all of that equipment that we sent to Ukraine. Number two, new contracts, such as the new F-35 jets contract worth $30 billion alone. And then we have the ramp up in defense spending across the globe, but specifically from the European allies. Germany alone is increasing defense spending by $20 billion. A lot of that money will go to Lockheed Martin. So there is not going to be a recession to this company, and therefore I keep it in my portfolio and I keep adding to it. Unfortunately, though, some of the viewers did not get the memo. Here we have a viewer, and I believe this guy is a new viewer. I haven't seen him in the comments before, but he says, don't forget the Maverick told everyone to long Lockheed Martin at $420. It is currently at $390. Your investment advice made me lose all my money. Well, first of all, in this channel, if you've been watching for a while, I do not offer buy or sell investment advice. Never. Because that constitutes a contract between you and me, and I become responsible for that. The only people I give buy and sell advice to is my employer. That's the contract that I have. Number two, when you say that I told everybody to long Lockheed Martin at $420, are you too high or are you just making that up? Because if it is, I challenge you to find a piece of video with me saying, hey, everybody, go along Lockheed Martin at $420 a share. And if you find that video, I'll give you $1,000 right here in this program. The easiest $1,000 you ever made. You know why? Because you're not going to be able to find it. Because every time I talked about Lockheed, I talked about we're sticking with Lockheed Martin. We're sticking with the name. Why? Because I actually announced that I bought Lockheed Martin and I added it to my portfolio last year, the 8th of March, 2021. This is when I announced that I'm long Lockheed. Since then, the stock went higher and added almost 42% worth of gains. And even after the latest drop, Lockheed Martin remains up by about 18% since my entry point. Matter of fact, when the company reported earnings last week, the stock went down, and I used that opportunity to add to my shares. This is a 5-minute chart right after earnings. You see that big green candle? That was me buying Lockheed. And since then, the stock added another 5% or so worth of gains. We will look at the heat map, the S&P 500, year-to-date performance. Which stocks are gaining year to date? Not a lot. Some in big pharma, some in the fertilizer names, oil and gas for sure. But we also have the defense contractors, Lockheed, Northrop, Raytheon, all in the green. This stance changes, and I become negative on Lockheed if the government cuts defense spending. Now ask yourself a question. Is the government going to cut defense spending when we have this proxy war over in Ukraine? You think the government's going to announce, hey, we're cutting defense spending, by the way? That's not going to happen. You might see the country in a recession and people losing their homes, their jobs, their cars, etc., while the government announces increasing defense spending. Not decreasing, increasing. And soon enough, we will hear the $1 trillion mark. $1 trillion in defense spending. Because, we're going down the same way the Roman Empire went down. We're going to choke on our own blood, but that's a different story. The bottom line is, the tailwinds are intact for Lockheed Martin. At this stage of the game in the stock market, you must ask one important question. Is the stock in your portfolio depends on strong consumer spending? If the answer is yes, you better get rid of that stock immediately, because consumer spending will get a lot weaker in the coming months. But if the stock that you own in your portfolio depends on government spending, specifically things related to national security, then there is not going to be a recession in that particular stock. Enough said. What about Netflix? What's going on here? The headline reads, Netflix lost nearly 1 million subscribers last quarter. What are they talking about? The revenue per segment, this is the regional segments for Netflix, the revenue in the US and Canada went higher month over over month, because this is what really important. I don't look at the year over year. It's all about the month over month. Why? Because are they losing subscribers? Are they adding subscribers? And are they offsetting the loss of subscribers by increasing the prices they're charging on their current members? And therefore, we look at the month over month. In the US and Canada case, the revenue was actually up by 9.36% month over month, but members went down by about 1.3 million. They lost about 1.3 million subscribers. Now, Netflix has another cute trick up their sleeves. They want you to look at the average revenue per membership, but here's the problem with that. It doesn't matter to me how much you're making per member. What matters to me is, are you increasing the bottom line, the net income of the company, month over month, year over year? Are you increasing sales month over month, year over year? That's all what matters to me. All these cute trickeries of let's use the average revenue per membership to put a lipstick on a pig, I'm not going to fall for that. We look at the Europe, Middle East, and Africa. Revenues were up by 2.3% month over month, but they lost about 760,000 subscribers. For Latin America, the revenue was up by 19.6%. The problem is, they also lost a little bit of subscribers, not a lot. So we have strength here in Latin America. And we've seen this theme from many other companies. The Latin America remains resilient for now when it comes to the consumer. We've seen that from Mondelez. We've seen that from PepsiCo. And now we're seeing it from Netflix, that the Latin American subscribers and consumer may be in a lot better shape than the rest of consumers. Maybe the pricing that Netflix offers in Latin America is a lot more attractive. Maybe that is the reason the company's not seeing that churn rate moving higher in Latin America. When it comes to APAC, Asia Pacific, revenue is up by 13.6% month over month, but they also lost about 1 million subscribers from that region. All in all, what really matters to me is the revenue's moving higher. The problem is how sustainable that is. If you continue to lose subscribers, that means you have to continue to increase the pricing. At what point does the consumer taps out and says, you know what, this is too much. I cannot afford to pay this much. Furthermore, Genius Sarandis, his latest idea is an ad model. So it's a free Netflix membership with ads. What is the cannibalization rate from that model? And will the ads substitute for the loss of revenue from cannibalization? That's an important question. This is a company that is in a midlife crisis, if you may. It has been hot. It has been the best performing stock of the decade of the 2010s, but now we're realizing that the business model is not that sustainable. So the company has to change itself, has to change the way it makes revenues and profits. And as an investor, do you really want to be amidst that storm? Or do you want to wait for the management to give us the clear signal that they're done? They've figured it out. They're done with the model. Here's the new model. Here's what we're going to do. And oh, by the way, here's the results. And then I'm interested, because for now, we will look at the numbers. Revenues all in all for the company entirely went higher by 1.3% year over year, but the cost of revenues went higher by 9.5% year over year. Marketing costs went higher by 3.41% year over year. Technology and development costs went higher by 9%. General and administrative costs went higher by 2.85% year over year. All in all, the operating income went down by 20% year over year. This is not good. It means that they're spending more, but they're not making enough revenue. And that brings up another problem with this company. Management. If management is going to spend tens, if not hundreds of millions of dollars on one movie, one show, is it really worth it? Because your revenue is static. You have X amount of members. They pay X amount of fees per month, and that's it. Where's your management in reducing your costs and becoming more efficient to raise the bottom line, the net income of the company? Because when we look at operating margins, that's 19.8%, not a good number for technology companies. But the bottom line, net income profits were down by almost 10% year over year. Now, what are the implications on the stock? The stock is already down big. It already priced perhaps all of these losses already in, and therefore we saw the positive reaction in Netflix. But I would not buy this stock even with your money, because it's amidst a storm. They need to change the business model. They need to figure out how to become more efficient in their spending. And until they do that, I'm not interested in buying the stock and waiting for the change to happen, and perhaps face the negative consequences from bad policy. Next, we have CSX. This is an important name, a railroad name, which will tell us a lot about the inflationary pressures in the economy. We'll look at the revenue year over year. That went higher by 28%. On the other hand, expenses went higher by 63% year over year. This is a bad dynamic because your revenues are increasing at a slower rate than your expenses, and therefore the net earnings came out at pretty much zero. No growth at all year over year. This is going to be a problem for the company. We'll talk about that in a minute, but not everything is bad with this company because their operation ratio, for example, is at 55.4%. That is a very decent ratio. We see that with railroad companies, one of the top companies when it comes to operating ratios. They tend to keep a lot of the money they make. But here's the challenge, and maybe you can help me out with that. Let me know in the comments. We will look at the revenue drivers. And this is the most important part of the conversation, by the way. What drove revenues higher for this company? Well, we have fertilizers with negative impact of 3%, yet we have coal. All of a sudden, the green energy lunacy is making coal great again. Germany is now talking about using coal once again, but the revenue from coal was up by 54% year over year. And notice the note that they have here. It says increased primarily due to higher exports benchmark prices, which more than offset the effect of lower export shipments. What does that mean? They're benefiting because prices of coal are shooting up to the moon, not because they're exporting more. This is an important take. Keep that in mind. Likewise, automotive revenue went higher by 24% year over year. And the note says increase due to a higher North American vehicle production as semiconductor availability has improved. Okay? Now, looking at the headwinds, what drove expenses higher year over year? We have quality carriers that added $241 to expenses. We have real estate gains adding $238 to expenses. Fuel added $210. Inflation added $56 year over year to expenses. Now, the challenge with every single company we're about to see earnings from is in the next few months, in the next few quarters. We know inflation is already peaking, at least for now. But the question is, will the tailwinds drop down faster and harder than the headwinds? If that is the case, then that will be a bad outlook for the company. But if the headwinds drop faster and harder than the tailwinds, that would be good news for the company, and it might make the stock investable at least for the next quarter or so. We will look at the expenses, the headwinds for CSX. Okay, we know that fuel costs went down, and the trajectory for now, they will continue to go down. This is good news for the company. Their expenses will go down from this point on. This is the assumption, of course. And the assumption goes for inflation costs. That will go down too in next coming months. Real estate gains, that's debatable along with quality carriers. These are expenses that the company has to make. Maybe they will drop in the next few quarters, maybe not. But the bottom line is fuel and inflation costs, the assumption for now, they will go down. What about the tailwinds? Are coal prices going to go down? If that is the case, are they going to go down faster and harder than the drop in fuel and inflation costs for the company? Or is that drop going to be slower? Are coal prices going to be stickier, for example? The same goes for automotives. Are we going to see more shipment of cars as the economy slows down? Will the demand go down and that will mean lower shipments of automobiles? Or is the supply that CSX is shipping right now responding to demand from last year? If that is the case, then they have to ship the cars either way. And if that is the case, once again, it means that maybe for this company, expenses will go down first, faster, harder than the drop in revenues. And that will be good news for the company in the short run. You have to look at each company with the same perspective. We know that inflation will slow down, but inflation has positive impacts and negative impacts for each company. Will the negatives go down first and faster than the positives? If that is the case, then the company is buyable. The stock of that company is buyable, at least for the next quarter. But if the opposite is true, and we see the positives dropping first and faster than the drop in the negative impacts of inflation, then that would be bad news for the company. Case in point, Walmart. That inflationary demand is all of a sudden cooling down while their fuel costs, their transportation costs, their wages, that negative impact from inflation is still here, sticking, and therefore Walmart suffering. Maybe it's a different picture for CSX. Let me know in the comments. Next, we have Tesla. What's going on here? The headline reads, Tesla reported a rise in quarterly profit as a string of price increases on its best-selling vehicles helped offset production challenges, but missed Wall Street estimates for quarterly revenue. What are they talking about? Well, automobile revenues were actually higher by 43% year over year. That is an impressive number, an impressive rate of growth. Now, on the other hand, operating expenses went higher by 13% year over year. So you have revenues growing faster, 43% and higher, versus expenses at 13% year over year. This is a very good dynamic, and therefore the operating margin came out at 14.6%. And most importantly, the net income, the bottom line, was a stunning 98% year over year. Was up 98%. You're not going to see these numbers from any automobile company, and therefore Tesla stock commands the premium that it has in the market right now. But here's the problem. And by the way, notice that everything I'm doing in this program right here when I do earnings is really simple. I can go crazy on you, but I know that the majority of retail investors don't have the time to go crazy with the numbers and looking at earnings professionally, and therefore I do it the street way. I do it the simple way, because everybody at home can do this and judge these companies' financials on their own. And a simple one that you can do is a trend chart via Excel. Really easy, takes 3 minutes to do. When we do that, here's the problem for Tesla. The trend for auto revenue, well, it appears to be stalling. It appears that the auto revenue for Tesla has peaked for now. The problem is we don't have a confirmation. We don't have a reading from the upcoming quarter that says, yeah, auto revenue went down quarter over quarter. That would be a problem, because the stock can command the premium when it comes to valuation so long as the company continues to deliver positive growth year over year, but most importantly, quarter over quarter. Once that story ends, the growth premium that we have in Tesla will go poof, gone, and the stock will have to be repriced down. Likewise, when we look at the operating margin, it appears that it is stalling. It already peaked in the first quarter of 2022. And now what? The problem is, once again, we don't have the confirmation from the next reading. But if the next reading comes down again, then we will have a confirmation that Tesla's growth has already peaked. And that would be bad news for the company, certainly bad news for the stock. And most importantly, when we talk about net income, the bottom line, it's a similar story. It appears that the net income growth for this company has already peaked, and it is trending down. We have yet to have the confirmation, but once we have that, it will be a problem for the company. Now, the stock might have shot up higher after earnings due to short covering and a gamma squeeze, yet at the end of the day, it will all depend whether we have peak growth in Tesla or not. If we do, the stock is going to react negatively, because you'll have the big shot investors dumping the stock. The premium in stock valuation will be gone. But if the company delivers once again next quarter, and we see these numbers in automobile revenues, in operating margins, in net income moving higher above the second quarter of 2022, then the stock will go higher. The stock will maintain the premium it has. You know my take. I'm bearish Tesla. I think they're not going to maintain this level of growth for too long. I think the growth already peaked for the company. With the competition ramping up, it's going to get worse. But next, we have American Airlines. What's going on here? Now, year over year, it's not going to be fair, because last year, the airlines business was not as hot as it is right now, for understandable reasons. The lockdowns, the restrictions, the yada, yada, yada. But I'm just showing you this because this is what American Airlines gave us. Year over year, the operating revenue was up by a stunning 79.5% year over year. Likewise, expenses went higher by 76.3% year over year. And look at that, the net income, a stunning growth of 2,505% year over year. But here's the problem. When we compare the numbers with 2019, which American Airlines should have done, the operating revenue was higher by 12.22% versus 2019, but expenses went higher by 14.78% versus 2019. So you have the rate of growth in expenses shadowing the growth rate in revenues. This is not a good dynamic, and therefore the net income was actually down by 28% from 2019 levels. This is a problem for the company because, once again, the same discussion with CSX. As inflation starts to cool down, inflation was a double-edged sword for the company. It increased their ticket revenues, but it also shot up their expenses, their jet fuel expenses, maintenance, salaries, etc., a lot higher. Which one will go down first? Or which one will go down fastest and harder? Is it going to be the drop in expenses or the drop in revenues? And the answer to this question will determine whether these airline stocks will still be hot all the way till the end of the year, at least holding. They're not really hot, but will they at least hold, or are they going to crash entirely? Well, they're going to crash if the drop in revenues, ticket revenues, go down first, faster and harder than the drop in expenses. Now we're done with the summer season almost, so that bump will go down, will go dormant until the holiday season. In the meantime, will fuel costs also go down? Will maintenance costs also go down by the same amount, or are they going to stick higher? If they do, this will be a bad outcome for American Airlines and the rest of them, not just American Airlines. I'm actually bearish airlines. I happen to be short American Airlines, and the reason is the balance sheet is absolutely horrible. Despite the bailouts that we gave them, they're not going to make it. If inflation sticks, if the Fed continues to increase interest rates higher, this is a zombie company that will blow up. Speaking of zombie companies, here's Snapchat. What a disaster this report was. The headline reads, Snap shares sink 25%. As growth flatters, our financial results for Q2 do not reflect our ambition, says CEO Evan Spiegel. Now, Evan Spiegel should not be worried at all whether his stock is crashing or not, because he already cashed out in this Ponzi scheme we call the stock market. I made a video about it about 5 months ago. People who watch that video always leave comments. It's a good video, it's hilarious, but it also makes their blood boil. It's a scam. You see Walmart crashing after hours. It has been crashing for a while now. The Waltons dumped billions and billions of dollars last year. Snapchat is even more egregious because Evan Spiegel and his CFO dumped hundreds of millions of dollars at the top, exactly at the top, because they knew their company is trash and it's overvalued, and they will take that advantage by cashing out. So when you geniuses, retail mom and pop, you chase these bubbles, these mania stocks with no fundamentals at all what you're doing is wealth transferring from your pocket, the poor, the middle class, the regular Joe and Jane, to the pockets of the rich, like Evan Spiegel, who cashed out and he bought $100 million home. He doesn't really care whether Snapchat stock crashes or not. The guy already won. But Snapchat investors, that's a different story. So what's going on here with the company's financials? Well, the revenue went higher by 13.11% year over year. On the other hand, costs, expenses went higher by 28.7% year over year. You have the dynamic of expenses rising at a faster rate, at a higher rate than the rate of growth in revenues, and therefore the net income, there was no actually net income, there was a net loss that increased by 278.30% year over year. Horrific. This company, I cannot believe that at some point this company was valued at $100 billion. That was genius, right? Thinking that a trash company like Snapchat is worth $100 billion? To the moon, bro, right? Well, to the moon, your money went to the pockets of Evan Spiegel, and he bought a nice house with it. You lost your money. Congratulations. And oh, by the way, this pain that we saw in Snapchat, the advertisers' revenue down big year over year, there was something behind it, and I made this comment on Twitter. I said, as a YouTuber, let me tell you that my ad revenue is down big recently, even though my views are actually higher. Why? The crash in the tulip market has ripple impacts. Crypto ads used to pay a prime rate. They're going bankrupt now. I'm not surprised that Snapchat crashed. Google is next. You see, everybody talks about Google being cheap. YouTube revenue is going to go higher. You won't want to buy Google. I'm not sure about that because crypto ads used to pay a lot. You didn't have to have a lot of viewers or a lot of clicks. If you happen to be a financial channel with a lot of crypto ads, you made a lot of money. But now we're not seeing these crypto ads anymore because the crypto mania already crashed. It is crashing as we speak. A lot of these companies are going bankrupt. They spent a lot of money in marketing and advertising. Thank you so much. We got a lot of that money, us YouTubers, but now they're gone. And of course I miss them because my rate is down. But the bottom line is, if my rate is down, if my revenue is down because crypto ads are now gone, this is going to be a problem for the industry, not just for Snapchat. Crypto ads are not doing Snapchat ads anymore, not doing TikTok, and they're not going to be doing YouTube anymore. That's a problem. That's a problem for the entire industry, not just the YouTubes and Snapchats and Instagrams of the world, but even for TV. Last year, the Super Bowl, a lot of these ads were crypto ads, paying top dollars, prime rate for these ads. Well, now they're gone. They cannot afford to pay these fees anymore. That will be bad for the entirety of the ad business. And lastly, we have American Express. This is an important name for the health of the consumer and consumer spending, specifically the affluent consumer. And in the previous video, we talked about how the affluent consumer is now spared the recessionary force. The recession is hitting the poor and the lower middle class for now. Little by little, it's going to hit the middle class, the upper middle class, the rich, and it goes on and on. So for now, we're not seeing the negative impact in American Express, but there are signs to worry about. The revenues year over year for Amex went higher by 31%. And mind you, 2021 lockdowns, slowdown in spending. It would be more fair to compare these numbers with 2019, but let's take them at face value. Revenues were higher by 31% year over year. Expenses were higher by 32% year over year. So all in all, you have the growth rate in expenses an inch higher than the growth rate in revenues, and therefore the net income is down by 14%. Now you might say this is a little exaggerated. Why down 14%? Should have been down 1 to 2%. The answer to that is the provisions for credit losses. This is the money that the company keeps on the side in case they have defaults on their loans. Last year, they actually had to take money away from that stash because they did not need it. The economy was hot, the risk of defaults was very low, but now they're adding about $400 million in that stash of provisions of credit losses, meaning they're anticipating that they could see a higher rate of delinquencies, a higher rate of defaults. Perhaps they see the economy slowing down a lot in the next few quarters. When you factor all that in, you get a net income down 14% year over year. So the results, the bottom line for the company, so far, not really bad. But the problem is when you look in the future, that's when it gets a little scary. Another alarming sign, when we look at the balance sheet, the cash and cash equivalent for the company went down by 15% year over year. On the other hand, the long-term debt went higher by 8% year over year. So a little bit of weakness in the balance sheet. I am short American Express, and the reason is I believe all of these travel names will collapse in the next few quarters. The myth of the strong consumer, the consumer is not going to be able to travel and spend in hospitality and leisure when the economy is heading into a recession. Anyhow, we have mixed signals here from all of these earnings. Certain companies show weakness in the economy, others not yet, but you find out that these companies like Amex, for example, tend to cater to the affluent consumer, and companies who are experiencing pain right now tend to cater to the not so affluent consumer. Another point is, just like with airlines, for example, or CSX, they're increasing rates, they're increasing the fees they're charging to offset the cost of inflation, but they're not doing it enough. Maybe because their accounting is bad, or maybe because the demand will go down by the consumer if they increase these rates by a lot. And therefore, we're seeing the dynamic of companies' expenses growing faster and higher than the rate of growth of the revenues. This is how inflation crushes companies' earnings. So as inflation starts to cool down, the main question becomes, will the negative impacts of inflation cool down first and at a higher rate than the positive impacts of inflation in each company? That would be positive, and vice versa. If the positive impacts of inflation slow down faster and at a higher rate than the slowdown of the negative impacts of inflation in the company, that will be bad. That is one point you got to keep in mind for each earnings we're about to see. And boy, we're about to see a lot of them. Here are the earnings that we have for this week. Tuesday, tomorrow, we have 3M, Raytheon, General Motors, Coca-Cola, Mondelez, Chipotle, Alphabet, Visa, and Microsoft. Wednesday, we have Old Dominion, a stock that I'm watching, Owens Corning, another stock that I'm watching and I happen to own in my portfolio. We also have Shopify, Boeing, Qualcomm, Ford, ServiceNow, Etsy, and Meta. Meta will be closely watched for obvious reasons. Then we have Thursday, Pfizer, Harley-Davidson, Hershey's, another name that I own in my portfolio. It is an outperformer year to date. Can it hold this outperformance? We'll see. Then we have MasterCard, Intel, Apple, the most important earnings by far this week, on top of Amazon. Amazon, we know the story. The negatives already came out last quarter, and now we have Walmart after the bell impacting Amazon negatively. So I would say the surprise for Amazon will be actually to the upside, not the downside. And lastly, Friday, we have AbbVie, Procter & Gamble, Chevron, and ExxonMobil. And with that, folks, this is all I got for you for this video, but stick around and stay tuned, because later this evening, market commentary and the technical analysis will be out. Until then, thank you for listening. Thank you for watching. I will talk to you again soon.